Good morning, all of you, once again. So, today we are going to discuss about accounting concepts and conventions. As I mentioned in my last video, that we are going to discuss accounting concepts and conventions in the coming video. So, my name is Priyanka Mahanta, Assistant Professor, Business Administration Department, USTM. So, let's understand in deep detail about the accounting concepts and conventions, which are really very important basic things that we should know before moving on to the subject, or before moving on to our understand what is accounting, how to do it, what is ledger, what is trial balance. These things comes later on, but before we should know some concepts and conventions. Okay. So here, accounting is the language of business. So I think I already discussed about this in my last video itself. So we can say that accounting is a kind of language between whom? Between the business and the user. Okay, user means it can be the management or it can be the investor. That means both internal and external users. Okay, so accounting is a kind of language through which the business tries to express itself, like in what position it is, or whether the what is the position of the business, whether they are financially stable or not, whether they are having profit or not, or certain kind of things. Okay, so to make a language convey the same meaning to the all people, accountant all over the world have developed certain rules and procedures and conventions, which represent a similar view by the profession of good accounting practices and are referred to as GAAP. So we have already discussed about the term GAAP. Right? GAAP means generally accepted accounting principle. That means it's a kind of rules and regulations which is needed to be followed by the company while preparing the financial accounts, okay, at the end of the year. Why is it necessary? Because if there is no rules and regulations, all the company will make the financial account according to themselves, because they don't have any guidelines, right? So if there is no guidelines, they will follow their own. So it will be difficult for all the peoples to understand which one is correct, or because every companies will have their own rules and regulations and own procedure, right, which will be difficult for everyone. So that's why, so that all the people can understand commonly, this set of rules or guidelines has been laid down, so that it will be easier for people to understand and also to compare between companies. So when they can compare, only when the financial statements are similar, then only they can compare, right? If the financial statements differ, it will be difficult for them to compare between the two companies. Like for example, if I need to select between two companies where I need to invest, definitely I'm going to uh, compare between the two companies. I'm going to see all the pros and all the cons, what are the advantages, what is the financial position, which will be more beneficial for me, like that. Okay, so on the basis of comparison, I will select the best one because I need profit. Okay, so here these principles rules have been developed by different accounting bodies with the main aim to maintain uniformity in the accounting practices and are imposed on companies so that the investors have a maximum level of consistency in the financial statements they use when analyzing companies' financial record for investment purpose. That's what I told you now. If I need to compare, if I need to invest, I am going to compare between the companies. I can compare only then when there is uniformity between two companies. Like for example, if there is company A and there is company B, right? Suppose the company A's profit is 50,000, company B's profit is 1 lakh, company A's asset is 1 lakh, company B's asset is 2 lakh, like that. Okay, I need to compare which one is better, which one is better for me. Better in the sense, which one will give me more profit, which company is more stable. Okay, stable in the sense financially stable or financially sound. Fine. So accounting statements are prepared by organization in conformity with these principles in order to place more reliance on them. The need for common practices is felt because of chaotic environment which prevails in organization if all the accountant could follow their own practice while recording the transactions. Moving on to the next. So, accounting principles have been defined as a body of doctrine commonly associated with the theory and procedure of accounting, serving as an explanation of current practices being followed as a guide for the selection of convention and procedures where alternative exist. Okay, so if there is an alternative way, okay, alternative way in the sense how we can do the accounts part, so these principles will guide us which one to follow and how to follow. Okay. In simple words, accounting principles are those rules of conduct or procedure which are adopted by the accountant universally for recording and reporting of financial data. Fine. So how they're going to record the financial transactions, how they're going to report it. So this should be universal in nature. This should be same for all the companies. Okay, it's not that one company is reporting the profit in some other way and the other company is reporting the profit in some other way. So that will be a chaotic condition, okay, chaotic situation. So accounting principles can be classified into two categories. Okay, we have accounting concepts and we have accounting conventions. But today I think we are going to discuss about all the accounting concepts in details. Okay, we have more than 7-8 accounting concepts which are very important and we need to understand this in a deep manner. So let's see what are the concepts. So before moving on, here are some characteristics or features of accounting principles. Okay, some of the characteristics of accounting principles. See, first one is have no authoritative, or we can say steadiness as universal principle. So this means as the accounting principles are man-made, okay, they are man-made. We made it, the accountant made it. So they do not have the steadiness as universal principles like principle of physics or chemistry or biology. Okay, they simply represent the best possible guideline set by the accountant to improve the quality and effectiveness of accounting data. Okay, ultimately the accountant, they are providing this set of rules so that they can improve the quality of the accounting statements of all the companies and all should follow the same thing. Otherwise it will be different, and if it is not different, then the general public like us may get into some problematic situation. Okay, so actually they simply try to represent the best possible guideline, or we can say set of rule, okay, so that they can improve the quality and effectiveness of accounting data and also to maintain the consistency in representing the financial statement year after year. So every year the companies need to set up or to make the financial statement. Okay, so it should be same. If one company is following this particular set of rule from the gap, then they have to follow that itself. They cannot just change their their rules and regulations every single year. They have to be steady, they have to be consistent. Next one, accounting principles are still evolving. Okay, so accounting principles are not in their finished form. Since the principles are influenced by change in the social or economic or legal environment, they need to be revised, modified, or we can say change continuously so as to match up the dynamic environment. We all know that there are certain major changes in our environment. Okay, so when there are certain changes in the environment, these things are also needed to be we can say improved so that they can cope up with the current environment. Next one, acceptance of principle is dependent on various factors. So how well the accounting principles are accepted depends upon its relevance, its objectivity, and its feasibility. Okay, So how we are going to accept the principles, it depends upon the relevance, it depends upon the objectivity, it depends upon the feasibility of the principle. So a principle is relevant, okay, if it results in information that is useful to those seeking information, that is, if the statement provides relevant data. Relevant data means the accurate data or the real data. If there is some mismatch in the data, or the data got some wrong into it, or it is not relevant, then the statement or the financial statement will not provide the correct information to the user, whoever is using the financial statements. And the next one is, a principle is objective if the accounting information is not influenced by the personal business of those furnishing the information. Whenever we are furnishing the information, it should not be influenced according to the suppose if I am the accountant, okay, I'm the accountant and I need to change this part according to my convenience, I cannot do it. Okay, it should be we can say true, it should be true, I cannot change because of my personal greediness. Okay, and a principle is feasible to the extent that it can be applied without undue complexity or cost. And this principle should be easily, I can say, implementable without much expenses or without much expenditure and without much, we can say, chaotic or some complexity which we cannot understand. It should be easily implemented. Okay. Next one, accounting principles cannot be validated or proved by reference to natural law. Okay, as in the case of, we can say, science or physical science, these principles cannot be proved with reference to natural laws. Okay, they are simply the suggestion based on practical experience, or we can say reasons and observations, which have been developed by the accountant or authorities engaged in the accounting profession over the years. Like the laws of any kind of laws related to science, accounting principles are not like that. Okay, these are just we can say observations done by the accountant over the period of years. They have seen, they have the experience on it. According to their observations, according to their experience, they have made these accounting principles. Okay. Last one, accounting principles are not rigid. Okay, so accounting principles are very changing. Okay, they are not rigid. Rigid in the sense, it's not like you cannot change it or something like that. Okay, principles can be easily modified as per the accountant's choice and as per the situation being faced while recording the transactions. Okay. Okay, moving on to the next slide. So here are the importance of accounting principles. Okay, why these accounting principles are important. So let's see. Accounting principles are very important part of every organization, as following them properly helps an organization in presenting a true picture of their financial strength. And it is very important to be true, okay, because the public is going to judge you on this. So if you make any kind of falsification or any kind of false data, then it will create some kind of, we can say, loss to your company, because it will create a negative impact on your company. So following are the points of importance of accounting principles. So the first one is usefulness of accounting data is enhanced. Okay, so organization prepare financial accounts in order to make them available to the owner for decision making and to the investors to persuade to invest in the company. So why do we make the accounting things? We make it so that we can make it available to our owner in the sense the shareholder. Okay, the shareholders of the company, they should know what is the actual position of the company, what is the financial position of the company. Okay, and also to the investors, because all the companies, they do need investment. they do need financing. Okay, so who is going to do it? It is the investors. The investors are going to invest in the company only when they get some kind of trust in the company. They know that this company is going to do well. Okay, so preparing the statement in accordance with GAAP. GAAP means generally accepted accounting principles, enhance the usefulness of the data to the investors, as they can easily, without getting confused, compare the data of two or more companies following the same accounting standard. Okay, so here comes the same thing again. So when the investor is going to invest, they will try to compare two companies of similar standard and see which one is better, which one is better option. Next one, establishes a great accountability and transparency, which is really important while preparing the financial statement. Okay, so preparing a financial report in compliance with GAAP. So whenever we are following the principles, okay, it establishes the accountability and helps in transparent working in the organization, hence presenting a clean and clear picture of the financial performance to the interested users of its account. So whenever there is transparency and whenever there is accountability, the user will definitely trust in the company. Okay. Next one is maintains consistency. So accounting principles establishes a consistency which frames in the presentation of financial accounts, as similar ways of recording the transaction takes place year after year, and that follows for more accurate and efficient viewing of company statement and report. So they try to maintain a consistency. Suppose company A is following certain set of rules and regulations or certain set of standards every year. They need to maintain that consistency every year. It's not that one year they are following certain different kind of standard, again in the next year they're changing the standard. Okay, they should have a consistency among them. Okay. Next one, makes the account universally understandable. So GAAP are the general guidelines which frames a common set of procedure and rules to be followed in order to maintain the accounts. Hence, it converts the account in a common language universally understandable and acceptable by all the investors. So whenever we are following the GAAP, or we can say the principles, it makes the data, we can say, universally understandable. Okay, this means all the investors can easily understand and usually can know what is the financial statement is telling about. Okay, because all the companies follow the same thing, it's universal, so it will become easy for them to understand. Okay, last one is provides relevant data. So an accountant, while preparing the accounts, follow the accounting principle and ensure that only relevant data is presented in the books of account that may assist the interest user to form, confirm, or maybe revise a view, usually and in the context of decision making. So only the relevant data should be presented, and it is the responsibility of the accountant to ensure that only the relevant data is provided over there. Okay, then only it will help the user to take decision regarding any kind of investment. Now we are going to discuss about accounting concepts. So the business affair need to be communicated to the interested parties as well as to the owner of business through accounting information, which has to be suitably recorded, classified, summarized, and presented. Accountant make sure that they use simple and understandable language. If the language is to be understood by all, it must obtain certain concepts which are universally acceptable and understandable. So here are the concepts. Okay, we have total 8 concepts. So there are various accounting concepts that are followed by accountant while maintaining the financial statement. So let's see one by one. First one is business entity concept. money measurement concept, going concern concept, cost concept, dual aspect concept, accounting period concept, matching concept, and last one is realization concept. So let's understand. Okay, the first one, which is business entity concept. So this is really interesting. It means that this concept implies that business unit is separate and distinct, okay, from the person who supply capital to it. Okay, that means the business and the owner of the business is treated as two different person, the business and the owner. Okay, so that means that business has a separate legal entity from its owner. Okay, maybe I have a business, but I cannot think that this business is mine, so I will treat both the things as together, my personal and the business. Okay, so I have to keep my personal expenses or personal things separate from the business. Okay, so business and the owner are two different entity. Fine. So for the purpose of accounting, the business and its owner are treated as two separate persons. Okay, irrespective of the form of an organization, a business unit has got a separate entity as distinguished from the person who controls it. Okay, business is kept separate from the proprietor, so the transaction of the business may not be recorded with him. Okay, so in case this concept is not followed, affairs of the business will be mixed up with the private affairs of the proprietor. Okay, I am the owner of the company, but I'm not going to mix up my expenses or my transactions with the business. The business transactions are a different thing and my personal transactions are a different thing, being an owner even. Okay, so I should keep all my business things separate. That's why I'm treating my business as a separate person itself, separate entity itself. So this is what the first concept means. Okay, now the second one, the money measurement concept. Now when we are talking about accounts or finance, it's all about not in quantitative form but in quantitative form, right? Quantitative means a number which we can quantify. Okay, so whenever we are talking about finance or accounts, I think first thing comes into your mind is money. Okay, first thing that comes into our mind is money. So the concept money measurement states that only those transactions, or we can say events, okay, in the organization which has been expressed in terms of money are to be recorded in the books of account. Okay, only those transactions which are which can be quantified in terms of money, only those things will come under the books of account. Okay, all those things which cannot be expressed in monetary terms, such as the appointment of a manager or the creativity of the production team, okay, these things are qualitative in nature. These things we cannot quantify in terms of money. That's why it is not recorded in the books of account. Fine. Now next one, going concern concept. So this concept, going concern concept, means that business firm will continue to carry out its operation, okay, indefinitely. That is for fairly long period of time and would not be liquidated or terminated in the foreseeable future. So this is just an assumption of accounting, as it provides the very basis of showing the value of assets in the balance sheet. So whenever we are preparing the financial statement, we think that the company is going to run for a longer period of time. It's not that after 2 years I'm going to just liquidate it. Okay, not like that. We need to think that this business is going to run for an indefinite period of time. Okay, now moving on to the next concept. Next one, cost concept. So what is cost? So the cost concept states that the asset means the things, assets like, for example, some kind of machinery or land or some security or some investment, okay, is recorded in the books of account at the price paid to acquire it, and that this cost is the basis for all subsequent accounting for that asset. This does not mean that the asset will always be shown at cost, but it means that the acquiring cost becomes basis for all future accounting for that asset. Now, in simple terms, if we need to understand this, the market value of asset may change with the passage of time, right? For example, 5 years before, I purchased a laptop of 25,000, right? Now that same laptop is costing me around 35,000 after 5 years. So there is a difference of 10,000 rupees for this 5 years gap, right? Before 5 years, I was getting at 25,000, but after passage of time, now that laptop is costing you 35,000. So you can see that there is a change, right? Change means there is a change in the cost of the asset. Okay, which you could have acquired at 25,000. Now you need to pay 35,000 to get the same laptop. Okay, so with the passage of time, the value of the asset or the market value of the asset may change. But for accounting purpose, it continues to be shown in the book at the book value itself. That is, the cost at which it was purchased minus depreciation provided up to date. That means when I'm going to record the laptop in my financial statement, I'm not going to show it as 35,000 in today's date. I'm going to show it as 25,000 itself, because I have acquired this 5 years before itself, right? So 5 years before I got that at 25,000. But there is also depreciation, right? What is depreciation now? Depreciation means the reduction in the value of the asset due to its wear and tear or due to its usage. Whenever you use the asset, its value depreciate or its value decreases. Okay, but there is one thing which the value never decreases, and it is the land. Whenever you're purchasing land, the value of land does not get depreciated, it always get appreciated. Okay, so now the next one, which is dual aspect concept. So it is the foundation, or we can say the main principle of accounting. It provides a very basis of recording business transactions in the books of account. So this concept assumes that every transaction has a dual effect. Dual effect means it can be debit or credit. If one's account is increasing, the another account is increasing, right? Suppose if I am paying the money to the supplier, that means what? Money is going out from me. That means money is my asset. My asset is going down, but I am paying to the supplier. His account or his asset is going up, right? So it has a dual effect. This is known as dual effect or dual aspect of each and every transaction. And this is the basic thing which is very important in the accounts. We should know that each and every transaction has two aspects. Okay, one is debit, another one is credit. Next one, accounting period concept. Okay, so all the transactions are recorded in the books of account on the assumption that profit on these transactions are to be ascertained for specified period. Specified period means we have a time period, right? So this period is known as accounting period. Now, accounting period refers to period of time at the end of which the financial statements are prepared. Okay, when do we prepare normally or generally? We can say at the end of every March, right? 31st March, we can say it is the accounting period, or as we call it as the financial period. Okay, so starting from 1st April to 31st of March. So this is our accounting period. Moving on to the next one. This one is matching concept. So this concept is based on accounting period concept itself. The most important objective of running a business is to ascertain profit periodically. That means the determination of profit of a particular accounting period is essentially a process of matching the revenue or recognized during the period and the cost to be allocated to the period to obtain the revenue. Okay, that means we need to match our revenues and our expenses. Right? The last one, which is our realization concept. So this concept implies that revenue is deemed to be earned when it is realized. Okay, so this concept states that revenue from any business transaction should be included in the accounting record only when it is realized. That means you can record the transaction only when you have actually received the revenue, when you have actually received the money from the client or from the supplier. Okay, so revenue is generally deemed to be realized when goods are shipped or delivered to the customer, and not when sale order is received or when a contract is signed. Okay, so I think it's clear to all of you the concepts. Next, we have accounting conventions. So accounting conventions we will be discussing in detail in the next video. We have 4 accounting conventions, which are consistency, full disclosure, conservatism, and materiality. So these are the 4 conventions of accounts which we will discuss in our next video. Thank you.